There are some investing mistakes that I did when I first started investing that I wish I knew about earlier. So today I'm sharing with you the 6 investing mistakes to avoid to become a millionaire. And make sure to stick around to the end because I think the last one is a very important one that not many people pay attention to. In the investing world today, brokerages like Robinhood have made it very easy to get into investing. This is a good thing because it allows people to invest easier than ever before, but this is also a bad thing because it allows people to invest easier than ever before. See, Robinhood is designed like a casino with many flashing colors, dopamine-inducing animations, and the ease of use. This makes it very easy to spend thousands with the click of a button. Which takes us to our first investing mistake, and that's not doing your due diligence and just buying any random stock. In the investing world today, many people just jump into a random stock because they see it online or they see a headline on Twitter saying, the next Apple stock must buy right now. Or they just see the chart going up and they think it's going to go up forever. And by taking this strategy or lack of strategy, you're basically gambling with your stocks in the hopes that it goes up. When it comes to stock picking, you want to make sure that you're doing your due diligence and you're doing your research on the individual stocks that you're buying. Individual stock research includes things like balance sheets, cash flow, income statements, where the company is going, where the direction of the industry is going, how their competitors are doing, and so much more. There's a few ways to actually avoid this mistake, and the first one is actually doing your research with these stocks. Rather than jumping onto the latest trend, pick stocks that you know about, pick stocks that you're familiar with. But if you don't have the time or the care to go into that level of detail with stocks, there's another way that you can avoid this mistake, and that's by investing in index funds. See, index funds allow you to invest into the stock market as a whole. They package many individual stocks like the S&P 500 and sells it to you at an affordable price. This way you don't need to do individual research on every single stock. You can diversify a bit more than the top 500 companies in America if you'd like to. You can invest in a total US stock market ETF like VTI. By purchasing this ETF, you're basically purchasing a piece of every single company in America. If you do insist on buying individual stocks, that's fine, more power to you, just make sure you're doing the proper research. The second mistake that I see a lot of investors do, and that I did myself, is letting your emotions control the game of investing. See, investing comes down to one thing: numbers. Doesn't matter how you feel, at the end of the day, if a company is not a good company, it's not a good company. But unfortunately, a lot of people let their emotions make their decisions rather than the numbers of a specific company. This could be whether you're holding on to a stock that's 25% down, and it's very easy to say,
I'm just gonna hold on to it because I know this stock is gonna rebound because all stocks go up.
See, that's your emotions taking over. The fear of losing money and the hope of it going up. But in the end, the decision to hold on to this company needs to be made by the numbers. Why is the stock down 25%? Is the company going in a bad direction? Is the industry going in a bad direction? Are they going to continue to go down? And if it is going to continue to fall, it's time to put your emotions to the side and cut your losses. Fear isn't the only emotion that takes place when investing. The other one is greed. And greed in the stock market can easily turn a $1,000 gain into a $1,000 loss. This usually happens when someone doesn't have clear goals on their investing. You'll see greed take place when someone holding a stock sees it go up 20 or 30%. They say, oh, it's still going up, I'm gonna hold it till 40%. Gets to 40%, oh, I'm just gonna wait till 50%. Then soon enough, you know, that stock reverses and they're down 40%. But rather than letting your greed take over and chasing the gains, here's a few things that you can do. The first thing that you can do is set a clear goal and know when you're going to sell. If your goal was set to make 15%, but you're up 20%, don't get greedy and wait for 25%. Sell as soon as possible because that could fall just as easily. On the other hand, in order to minimize your losses, you can set up what's called stop losses. A stop loss is an agreement between you and the broker to sell your stock at a certain price. This means if the stock falls 10% below your cost, it's going to automatically sell and make sure you're not losing any more money. Now, this next mistake can easily cost you hundreds of thousands and maybe even millions of dollars. And that's not starting as soon as possible. See, there's a few reasons why people don't start as soon as possible, and the first one being they're trying to time the market. They're sitting on the sidelines waiting for the stock market to hit the absolute bottom so they can buy all the stocks in the world and time it perfectly. See, this doesn't happen. No one knows what's going to happen to the stock market tomorrow, next week, or even next month. So waiting on the sidelines and trying to time the market is absolutely the worst thing you can do. By sitting on the sidelines waiting for that looming crash that's bound to happen, what you're really doing is losing out on the gains that you would have had if you just invested when you first had it. Because it really is time in the market rather than timing the market. Overall, we're more likely to see a positive return on the S&P 500 than a negative return over the year. And looking at the S&P 500 returns annually since 1980, we've seen 8 negative years, while on the other hand, we've seen 35 positive years, most of those being over 10 or even 20%. So this goes to show, don't wait for that 1 year. Just invest and let the market do its thing. And if you're not comfortable throwing all your money in the stock market as soon as you have it, you can even dollar cost average. Throw some money every month or every 2 months into the stock market and get some growth on that. And the second reason that people don't start investing early is They just don't realize how big of an advantage they have by starting early. And to show this impact, let's take a look at two people. The first one, let's say his name is Andy. Andy is going to invest $200 a month into an S&P index fund which returns on average 10% until his retirement age of 60 years old. That's $200 every month for 40 years. When his 40-year investment period is over, he would have invested $96,000 over that 40-year span. And that $96,000 would turn into $1,062,000. Now on the other hand, we have John, who is person number 2. John is actually 30 years old and investing more every single month. He's investing $300 until the age of 60. John will be investing $300 a month for 30 years consecutively. Once John reaches retirement age of 60 years old, he would have invested $108,000. So John invested more, so he's going to have more money than Andy, right? John only ends up with $592,000. That's almost $500,000 less than Andy because he waited 10 years. Investing is exponential. The longer you have your money in there, the faster it's going to grow and the more money you're going to have in the end. So the amount of money you invest isn't necessarily the powerful thing. The powerful thing is how long you keep that money in there. So no matter what your age is, you can't go back in time and start earlier, but you can start today. So make sure to take advantage of that. Mistake number 4, and that's getting hit with so many fees. It could be an expense ratio. It could be an active advisor who you're paying. And the most dangerous part about fees is how small they actually seem, but in reality, they can make a huge difference. Based on this chart from the SEC, we can see how fees will affect a 4% return on your investment over a 20-year period. Let's say you have $100,000 and you invest that for 20 years. If you have a fee of 0.25%, just 1/4%, in the end you'll have a balance of $208,000. Now if that fee went up from 1/4% to 0.5%, your end balance will fall $10,000 to $198,000. And if that fee doubled again to 1%, your end balance will fall from $208,000 to $180,000. That's an almost $30,000 difference just by a difference in fees of 0.75%. The big thing about investing is a snowball effect. Sadly, the snowball effect also snowballs your fees. So the more you make, the more that fee is going to actually be. But luckily, there's a way to avoid this. The first way to avoid these high fees is try to stay away from actively managed ETFs. Many fund managers will put together a fund and sell it to you as a package, just like an index fund, but they actively manage what goes in and what goes out. And with these actively managed ETFs and funds, what happens is they have to make money somehow, so they'll charge you an expense ratio with an average expense ratio of 0.7%. So rather than investing in these actively managed ETFs with high fees, you can invest into a passively managed ETF like VTI, VT, or VOO with an expense ratio of just 0.03%. And anyways, we're all familiar with the bet that Warren Buffett made with hedge fund managers that they cannot outperform the S&P 500 over a long period of time. And as you know, he won that bet. So don't pay high fees for worse returns. And the second type of fee is an advisor fee. They'll charge you a few percentage points to handle your portfolio and make sure that you're getting good returns. But as we know, that 1 or 2% is actually bigger than it seems. If you insist on going with a financial advisor, make sure you find one who charges hourly or just a flat out fee and not a percentage based fee. Mistake number 5, paying taxes. No, I'm not talking about tax evasion. I'm talking about taking advantage of your tax advantage accounts like your 401k, your IRA, and your HSA. These are all retirement accounts that allowed you to legally avoid taxes now and during retirement. A traditional account, whether that's a 401k or an IRA, will allow you to defer your taxes to retirement so you don't have to pay any taxes now. By using this account, what you're doing is letting your tax money grow. And then once you get to retirement, you pay those taxes then. On the other hand, you have the Roth route. This allows you to pay your taxes now and not when you retire. If you were to invest in a normal brokerage account and not a tax advantaged account, when it comes time to pay your taxes, you could be paying anywhere between 15 and 30% on your gains. But if those investments were in something like a Roth IRA or a Roth 401k, when it comes to withdrawal, you'll be paying anywhere between 0 and 0% in taxes. And aside from these tax advantage accounts, one other benefit with your 401k is that the employer will incentivize you by matching the money you put in. So if you were to put in 4% of your paycheck, they will also put in 4% of your paycheck, which is basically free money. So make sure you're taking full advantage of your tax advantage accounts. So for this last tip, which is very important, we need to do some imagining. Let's say you get in your car, you pack the kids, you pack all the bags, and you're going on a road trip. You forget your phone at home, so you have no GPS and you have no map. You're not gonna just start driving hoping you get to your destination. That's not a good idea. So why do people treat investing the same? People will get into investing without knowing what their end goal is, or not having any goals in mind. You wanna know how much you wanna invest every month, how much you should be investing every month, how much you're gonna need during retirement and things like that, which will allow you to properly invest an amount that is right for you. You also wanna be looking at things like, do you want dividends? Do you want growth? Do you want value investing? Do you want index investing? Because these are all crucial to your investing career. And another reason why you should actually have an end goal is because investing is all about enjoying your money. It's easier to throw every single dime you have extra into the stock market and not spend a dollar, but that's not what money is for. We want to enjoy our money. There is a thing as oversaving, overinvesting. So by setting goals and knowing how much you actually should be investing, you could actually have more money into your pockets to spend. On the other hand, you could be someone who knows they want to retire with $1 million in the bank, but don't know how to get there because you didn't spend some time working on your goals, so you're just blindly throwing darts at a dartboard. And you could easily figure this out by following the 4% rule. I have another video on this specifically, which you're going to watch next, but I'm just going to give you an overall view of this. The 4% rule tells you how much you're going to need invested in order to properly fund your living expenses. And the rule is simple. However much you need in a year worth of money, just multiply that by 25, and that's how much money you should have invested. And it should last you the rest of retirement. If you expect to need $60,000 a year during retirement, multiply that by 25, and you now easily know that you need about $1.5 million in order to have $60,000 comfortably during retirement. And by breaking it down into monthly goals, you can realize that this is only a couple $100 every single month into an S&P 500 index fund. And to help you guys further break down those goals, watch this video next.